Hey everybody, it's Robert Dinan, your Florida Realtor, and welcome back to our podcast here, Luxury Living, all things Florida. We're all about luxury living, palm trees, beautiful breezes, and 80 degrees. So I'm here today with Ray Carota of Brandywine Financial. He's our guest again today because with big demand, he is back in action with us. Welcome, Ray.
Thanks.
Happy to have you back here. We're going to talk a little bit more about the markets and what's happening, and maybe a little bit about inflation.
Yeah.
And what that looks like in the marketplace now, and what ways you can kind of hedge maybe yourself against inflation. Mm-hmm. You know.
Yeah.
Why don't you talk a little bit about that for a second?
All right. So on the inflation front, we actually just had some PPI numbers come out this morning that were better than expected.
What's a PPI number? Right?
Personal Producer Index.
Okay.
All right, and that's one of the main indexes that the Fed actually looks at the most. They really look at core PPI, and core came in below expectations at 2.4 versus 2.7, and that means that Wall Street this morning is probably screaming, "Hey, you can cut rates now. You know, inflation is coming down." And just to be clear again on inflation, just because the rate is coming down, it doesn't mean inflation is coming down. It just means it's not going up as a faster rate as it was previously, right? So it's not going up at 9% or 7%, it's going up at 2 point something or 3 point something. And then you also
what are they saying inflation is going up at? What's their claim inflation rate is?
What's their target?
Yes.
Their target is 2%.
Now, what we've talked about this a couple times too. And, you know, when we were doing planning or financial planning in the past, right?
Yep.
You always planned on about 4%.
Roughly, yep.
For inflation.
Yep.
And now in one of the highest states that we're in here and possibly a economic change in the world here in the U.S.
Yep.
And globally maybe, they're at 2.7%. Is that what you're telling me?
Well, that's what they're telling us.
That's what they're telling us. Correct.
If you look at the way,
how do we help? So
if you look at the way they calculate inflation, and you actually change it back to the way we calculated inflation in the 80s,
right?
Inflation's probably
the Jimmy Carter era.
Yeah, it's probably 7, 8, 9% in reality. But they do these hedonic adjustments all the time on inflation that, you know, makes the government numbers look a lot better for them than they do, obviously, for us, the consumer that are paying for everything.
Well, why would they do that? Why do they do that?
Well, it helps in everything that they need it to help with. One is when you have social programs that have cost of living adjustments, like Social Security, for example. Well, everyone that's collecting Social Security annually gets a Social Security bump.
So just let me interrupt. When you talked about the cost of living, that's the COLA that people see on their
cost of living adjustment,
on their whatever their statements or whatever.
Yep.
Okay.
Yep.
That's COLA.
Yep. So that helps them pay less. Right, the government pay us or people that are receiving Social Security benefits less because
the cost of living is lower.
They're going to get a lesser of a bump every single year, so that saves the quote unquote government money, and it helps with the amount of money that they're collecting. Right, so when we pay more for things, and the government, let's be very clear here, the government needs higher inflation. I'm going to repeat that. The government needs higher inflation. Now, everybody's brain should go, well, why would they need higher inflation? Well, have you seen the deficit that we have at the federal government of $35 trillion? You know, the amount of money that each of us owe is about $104,000, $105,000 per citizen.
Right, per person.
Right.
Yeah.
And per taxpayer, it's like $260,000. So they need higher inflation.
So if I pay taxes, I actually have to pay more.
Yes, yeah, please. Yes.
Excellent.
Yes,
Excellent.
Please pay more. Yeah. Please pay. I'll take it if you like. I'll take it. So the higher inflation helps them pay down the debt a little bit sooner, right? Because so the more expensive things are, that means they collect more taxes every time we buy something. Hopefully, they're hoping that now wages have not really yet begun to rise in a meaningful fashion, but they're hoping that wages will rise. And what will that mean? That means that people making more money, well, they'll pay more taxes on that higher wage, right? So more money goes back to the government. So they get to collect more money and send it to Ukraine and Israel for all the wars that we're fighting around the world.
Right. Wars are moneymakers.
Amen.
Right. Wars are moneymakers.
Amen.
So let's talk about income tax for a second. Obviously, we're in Florida here. And the reason why a lot of wealthy individuals move to Florida is because of the no state income tax. Do you see that a lot with your customers now? Is that something that people are taking advantage of, moving to states with no income tax?
Yeah, all the time. You know, I'm recently moved here 2.5-ish years from Pennsylvania, Philadelphia myself. But historically, you know, over the course of the past 10 years or 15 years, I had clients that had houses down here. They lived in Jersey or Pennsylvania. And I said, change your residency. You know, go down there 6 months and a day change your
Like get
residency.
the homestead. Get your homestead.
Yeah, whatever.
Become
stop
a 6 months
paying,
and a day person.
Yeah, stop paying Jersey, because Jersey taxes.
Be a Florida resident.
Yeah, exactly. Because in Jersey, you pay taxes on your pension, you pay taxes on IRA distributions, you pay obviously other taxes on your state taxes on your income. Where in Florida, you don't pay any of that.
Of course. Well, I mean, in New York, if you actually work in New York City,
Oh,
yeah, it's triple tax.
Yeah, you're done.
So you get taxed in New York City tax, you get taxed federal tax, state tax.
Yep.
So you get hit 3 times.
right. And what happens when you have tax on top of tax on top of tax? When you want to go get a job in New York City, you're going to say, well, I need not $100,000 income, I need 125 because I got to pay all these extra taxes just to net what I would
To net what I would make out on Long Island.
Wherever,
or
right,
wherever.
whatever.
Yeah.
Right, exactly.
Philly, Pennsylvania, wherever you are. Yeah.
Yep.
Yeah. It's a strange situation that they've created for us all here.
Yeah.
Now, again, back to hedging against inflation. You know, people talk about, and I know we've talked about this, precious metals, but people talk about real estate, people talk about artwork, and people talk about, you know, precious metals like gold. So let's talk on gold. Yeah, let's talk a little bit on gold.
Like that one?
Yeah.
Gold, historically, people will say it's an inflation hedge. It's actually not the best inflation hedge. And if you look at historically, if you look back at the numbers like during the 80s, not that gold didn't do well, but it wasn't really an inflation hedge. Gold is what I call a fear hedge. Mm-hmm. Now, it's going to work with inflation, sure, but it's more, to me, it's more of a fear hedge. When there are geopolitical risks around the world, it tends to do really, really well.
Right.
And it's done really, really well. Today, it may be, I looked this morning before I left, it was up a couple of bucks, but it's right near an all-time high. But you never hear that on CNBC, Fox Business. They don't talk about gold because it's not sexy. It's not NVIDIA that, you know, has a sexy name or AI or whatever it might be. But it's very quietly.
And it hasn't done 32% in the last 4 days.
Yeah. Right, exactly. But it's outperformed the S&P 500 over the course of the past 2 years, and it's outperformed gold being that outperformance, and it's outperformed the S&P 500, not reinvesting dividends since 2002.
Since 2002.
Yeah.
Wow.
But nobody knows that, right? Nobody knows that.
20 plus years.
Yeah, yeah. Yep.
Wow. Wow. I didn't know that. Thank you.
You're welcome.
I appreciate that. I know there was always a lot of people I knew that were involved in gold, and gold was a big thing for many years. And you just don't hear too much about it because I think the big institutions don't want people to know about the gold.
The big institutions would be the central banks around the world.
Correct.
Right. The
That's when I say
institutions.
institutions. Yes.
That's right. The institutions that are hoarding all the gold, that have bought more gold in the past 24 months than they ever have in history, don't want anybody to own gold.
Right.
Right. And then you also have the situation with the BRIC nations, Russia, Brazil, India, China, where the Eastern blocs are now starting to use the dollar less and less and less for their transactions, which the dollar, for people that don't know the world, obviously the dollar is the world reserve currency. Every time a commodity...
Say it again. The dollar is what?
The dollar is the world reserve currency. Yes, the U.S. dollar is a world reserve currency. So every other country around the world, when they transact in goods or services like oil or gold, for example, when they buy different commodities...
It's calculated in the dollar.
They have... No, not only is it calculated in the dollar, they have to use dollars to make the purchase. Right, exactly. Right. So that has helped, keep the hegemony for the U.S. dollar since it, basically became the world reserve currency. And that is a challenge now because the U.S. government weaponized the dollar. When they told Russia a couple of years ago, when Russia went into Ukraine, when they told Russia, yeah, all those treasury bills you have was like $300 or $400 billion, they're worthless now. We're not giving you dollars back for them anymore because you went to war and we didn't want you to go to war. Well, if you were another country and you just saw the U.S. basically renege on their deal that says we'll give you dollars for this piece of paper of bond.
Correct.
What are you going to start to do? Well, you're going to start to say, well, what if they don't like something that we've done or we've said, and they say that our treasuries are worthless now?
Right.
So now you have a bunch of countries around the world that are saying,
I mean, I would, who wouldn't love that power?
Right. Mm-hmm.
Oh, yeah, just give me the money and then, nah, I'm not going to pay you now. Yep. How does that work?
Yep. Well, talk to the U.S. government because that's what they did to Russia. And now you have a bunch of countries.
We talked about this last week.
Yeah.
The ruble is doing fantastic.
Russia's doing just fine.
Yes.
So all the media and all the government information about how we've damaged Russia and how horrible their currency is, that's all lies. Russia's doing just fine.
100% on
just
that.
fine.
Yeah.
If you're still believing the propagandist media from the U.S., you really need to find an alternate source for information. That's all I can tell you.
There are a lot.
There are.
There are a lot.
There are.
All right. So going back to hedging your bet against.
So gold's a great hedge, right now because it's not only that we have inflation, but we also have fear because, I wouldn't be surprised if we walk out of here, we drop bombs on Iran. I mean, it's coming, right?
Yeah.
So, and kind of to that point, we're mad at Russia, right? Mm-hmm. Russia doesn't have a Rothschild central bank. We're mad at Iran. Iran doesn't have a Rothschild central bank. We bombed Iraq.
If you don't have a
Iraq
central
didn't
bank,
have a
those are the
Rothschild
ones.
central bank.
Right. Central banking is
Right. We
if
want
you
to
don't have
instill
central
it
banking,
everywhere.
you are the enemy.
That's right. If you don't follow the West central banking,
Rules and regs, you're not,
bad.
You're not on our team.
Right. We're going to bomb you. We're going to bomb you.
Phenomenal stuff.
Yeah.
Phenomenal stuff.
But to your point, back kind of full circle,
Yeah.
the three hedges. So real estate can be a great hedge. Obviously, you've seen what real estate has done. You're in, you're the premier agent here, so
Yeah,
you've seen what
we're
that's
looking
done
at
for us.
you're looking at price ratios compared to sale ratios. I mean, you're at about 96.5% from sale price to from list price to actual sale price.
Mm-hmm.
So prices are a little bit of a decline, but like by 0.13%. But it's still a valuable source, right? I mean, owning property, I think, is something that can always a value, right? We go back to what are the three main things that we need in life, right? Shelter being one of them.
Mm-hmm.
Water, shelter, right? Or some of the most importance for us.
Guns.
Yeah.
Sorry.
Nowadays, guns and weapons. Maybe.
Right.
Yeah.
Canned food and guns. Right.
Be prepared.
Right.
But yes, there's the average price in Florida has increased over the years now. I mean, as far as housing,
Yep.
it's I mean, we're not talking about the Longboat Keys or the Siesta Keys or Boca Grande or Clearwater Beach pricing, but the median price of property in the area is about $404,000 for a regular home in Florida,
Yep.
and increasing at about 8%. People talk about this, and you and I discussed this in detail. Well, the prices of homes are coming down. I see the prices of homes coming down. The prices of homes aren't coming down.
I just see price cuts. That's what I see.
Yeah, it's price cuts. It's
because they overpriced it.
Exactly.
Right.
Thank you for taking the words out of my
you're
mouth.
welcome.
They've overpriced it. They bought the listing instead of being
Right.
real with the people, and
Right.
the consumer now sees that as a price reduction.
I have 4 houses for sale in my neighborhood right now. My neighbor's house just got put up for sale, and then 3 around the corner. And when I first moved down here, houses were on the market for 2-3 weeks. Now. Yeah, it's 90 days plus to put it on the market, take it off the market, change the price a few times. I've seen some magic that some of these folks are trying to do.
I think, historically speaking, I've talked to Dan Hansen about this several times, and I know you and I have touched on this a little bit, but, again, we're in an election year, so there is a lot of noise.
There's an election this year?
Yes, there is. Believe it or not, there is an election. Get out there and vote. But
Early and often.
Yeah, early and often, exactly. There's many folks that feel, and the stats prove it, right, that in an election year, you have about an 87% drop in purchasing in an election year.
Wow.
And that goes from that late October until about January, right after the holidays. We always get a lull in the holidays, right? I mean, people really aren't thinking from the holiday time to New Year's anything. You usually see a spike here second week in January where you see it. But, if it's priced appropriately, like we talked about, priced appropriately, it should sell. If it's toothbrush ready, as I call it, you can walk into the property and not have to do anything but maybe paint the back wall that you don't like in the small bathroom.
Yep.
It's going to sell quickly if it's priced appropriately. But people need to understand now they have to stay, if they're listing their property now and it's priced appropriately, do not lower that price.
Right.
Or take the house off the market until January if you can wait. If not, and you want that discount the property. But I wouldn't discount the property if you're okay, because I think real estate's you're going to see a big change here after the election.
Oh, for sure.
Yeah.
100%.
So you talked about gold. We talked about real estate for hedging our bets.
How about recession? You want to talk about a recession?
Let's talk
the
about
R word, the dreaded R word.
Yes, let's talk
about the dreaded R word.
Let's talk about that.
So there was an article on CNBC.com yesterday that said that 59% of Americans are wrong that think we are currently in a recession. So they think everybody that's...
So 59% of the people out here are saying that we are in a recession.
They believe we are in a recession from the people that they surveyed. Right. And the report says that all those people are completely wrong.
The 59%
59% are wrong. Yeah.
Okay.
Yeah.
Well, then I'm wrong.
I don't believe they're wrong. No,
yeah, I'm wrong then. Because I'm wrong,
right?
Yeah.
Right. I believe we are in a recession. Every other data or metric that you look at, whether it is employment numbers, that you can't even really believe because they keep revising the numbers 2 and 3 months later. They come out with a lower number that people that are unemployed, and then 3 months later, all of a sudden, it rises by, they redo the number, recalculate it some way, somehow, and it jumps by 100 or 150,000.
Yeah, it's
So we
not real
actually
math.
lost.
It's not real math.
No, we actually lost over 1 million jobs in the past like 6 months, but that wasn't reported on the day it should have been, where if it was reported properly, the algorithms that control the stock market probably would have reacted differently.
Correct.
Because we have unemployment numbers rising, and we have them rise historically about 0.5% over a 6-month period. Going back 60 years, you get a recession every single time. And that's just one metric. That's not the purchasing manager, the PMI, which is called Purchasing Managers Indexes. Like just all kinds of other indexes and other little metrics that I track and watch. And they're all screaming a recession, except, of course, the government and the TV because they literally go down with the ship, right? If you think about when Ben Bernanke was the Federal Reserve Chairman in 2007, and he literally came out and said, this mortgage crisis is not going to bleed into the economy. Well, within a year, the entire financial world basically collapsed, and they had to print $800 billion and bail everybody out, right?
Hold on. Let's talk about. They didn't bail the investors out.
You didn't get a check?
Bail the house.
You didn't get a check?
No, I didn't get one.
I didn't get a check either.
They bailed out the big banks. Mm-hmm. Yeah, they bailed out the institutions.
Yeah.
The institutions that, again, could do no wrong, right?
Of course not. So did anybody go to jail?
Not the heads. The lower people.
I don't even think they went to jail.
I think the lower people went to jail. And I know some people that got affected by that, Well, my manager told me to do this. This is what protocol was. Right. This is what came down from up top.
I was just following orders is what the Nazis said. So,
Yeah. Well, when you're told from a manager standpoint, from, let's just use like a Wells Fargo, the president or CEO of Wells Fargo says, this is what we're doing, this is what we're doing. And then everybody tells everybody down to the branch manager, this is what we're doing. And then the branch managers get in trouble. And the CEO walks away with a bonus check for $14 million.
Severance bonus. Yeah.
So again, that to me is another issue.
It's one big club, and we ain't in it.
Yes. Yes. Cannot join.
That's right. That's right.
But yeah, I don't think anybody of stature, suffered any ill consequences.
No. And here's a great example of why I believe we're in a recession, and kind of getting back to the employment situation. I was talking to a client of mine last week.
Right.
She was in the JP Morgan Chase credit card division. She was been laid off for like 3 or 4 months. And I was talking to her last week.
How long was she with the job before then?
Oh gosh, she's been
years?
Probably 10 years.
Okay.
Yeah, probably 10 years. Probably a decade.
Seasoned employee.
Yeah, yep, absolutely. And she says, I'm sending my resume out 4 to 5 a week for different positions, and I'm not even getting an interview. 2 of her friends that were in the same division at JP Morgan that she's early 50s, 51, 52. Her other 2 friends.
So that's the issue.
Well, her other 2 friends are 60. They just got laid off. Same situation, sending resumes out, can't get an interview.
Yeah.
And
too expensive.
Sure, right. When they can hire somebody out of college to do the same thing for whatever, 40 grand instead of paying them 125, 150, whatever the number is. Or she's overqualified to keep telling, oh, you're overqualified for this position, or you're underqualified for that one.
Yeah.
Right. So
give me the interview for that.
Yeah, right. We'll see what happens, but things are going to soften, and everyone is screaming kind of full circle back to the rate cuts. And I don't think everybody remembers or understands that when the Fed is cutting rates, that means we're in a recession.
Stop for 1 second.
Yeah, go ahead.
I just want, so everybody is clear. When you're talking about rate cuts, explain what you mean by rate cuts.
So the Federal Reserve controls the short end of the interest rate curve.
Okay.
Right? And when they raise interest rates, that means theoretically our savings or our money market accounts will pay us more. Mortgage rates will go higher. When they cut rates, that means that our rates on our cash will go down, and what the banks have to pay us will go down, and hopefully mortgage rates will come down. So the Federal Reserve controls what we'll call the price of money.
Right.
That's a great way to put it, right? The price of money.
Of course.
So
for many, many years.
Since 1913, unfortunately. When they start to cut rates, historically, that means that we are either in a financial crisis, we are in a recession, unemployment is skyrocketing, there's a financial problem. They've only had what they call a soft landing, meaning they didn't do any damage to the economy or employment one time in the past 60 years. One time, I think it was 95, 96.
I was going to say 95, right?
Yeah, 95, 96, when they managed to. And maybe they figured out a way now that they can keep the stock market up by continuously printing money, But because that's what they do pretty much every weekday and month. If you watch, the Treasury has bond auctions every week, basically, where they sell bonds so that they can fund the government and wars and everything else that they want to do, right? So the Fed not recently, they've been bidding on these bonds. So if there's not enough like international or bank interest, the Fed then has to step in and buy those bonds. Because if they don't step in and buy those bonds, well, that's bad news for the United States.
Of course.
Right? So they print digital money on the computer, they give it to the Treasury, and they buy the bonds. And that adds liquidity to the system. And last Tuesday, when the stock market started skyrocketing, the Fed bid on almost $5 billion worth of bonds. And the stock market went straight up. And I had a client of mine say, oh, we should short today. I said, we can't short today. The Fed's buying bonds. And the market just went straight up. I said, as long as they're buying bonds, they're adding liquidity, and the market's going to stay higher. And as long as the Treasury or our government is spending $1 trillion every 100 days, yeah, the market's probably, they may come down a little bit, but they're not going to come down a lot. They will continually add liquidity. And as long as this liquidity is being added, there's no way that the equity markets or things are going to come down. Now, what that also adds to, though, is inflation.
Right. Of course it does.
You can't have inflation come down when a government is spending $1 trillion every 100 days. Doesn't make sense.
Do you see, no, of course it doesn't. But do you see them cutting rate? Because, there are a ton of people sitting on the sidelines here waiting for the rates to come down to
buy or sell,
which
move.
They never, they're never going to come down to where they were. So you have people sitting.
Never.
Okay, I won't say never.
We hope.
I would say it would be very unusual in my lifetime to see rates come down to where they were during COVID or 21, 22.
Yeah. Zero, basically.
Zero. Yeah. I mean, how does that even work? Okay, that I think was an enigma. Something that was, like I said, I don't think I'll see it again in my lifetime. Who knows? Do you believe that these people that are sitting on the sidelines why property values go up even if the rates do come down, right? To what, I don't know. That starts this frenzy again.
What are rates today? 6.5?
6.5.
6.5?
Yep.
Is that where we're at?
Yeah, 6.5.
So we were. What was the peak of rates?
Peak was 8. What 8.8, 8.9,
8 to 9.
Yeah.
I talked to the folks that are in the 3.5%, 3% range.
Where are they gonna get that again?
They're not. Right. So they're gonna say, well, I'd rather just stay in the home. We'll put a new bathroom in, put a new kitchen in, put a new whatever.
Improve,
right. We're gonna improve.
Yeah.
Right. And we'll just stay here.
Yeah.
Whatever. Fine.
Unless that life event happens.
Right. Sure. Move job. Another child. Whatever it might be. Death. Who knows? Right. So those people are looking at rates and values and going, there's no way. Maybe they can't even afford to move, right? Because their mortgage could be $2,500 a month. If they move, it's going to be $4,500 a month.
Yeah.
Right. For a similar house, right down the block,
same thing. It's
be, right next door. Right. It doesn't matter.
It's going to be $5,000 compared to two.
And then one thing I learned moving down here about taxes is that when you purchase, like your neighbor could have bought a house for $100,000 25 years ago. If you're buying the house now for $1 million, your taxes are based on the million, not
correct.
Like holy macaroni.
Correct.
That's a significant difference in what your payment's going to be, right?
Yes.
So these people that are, I call them
I typically
locked.
tell people, to calculate that about 2%.
Right.
It's not 2%, but to calculate it because conservatively.
Just in case.
Just I like to have more, to feel like I'm paying more. And then know when I come back, it's a little bit less.
Yep. Under promise, over deliver.
Right.
I like it.
And let them, that's just the simple mathematics for me. I always add a little.
Yep. A little cushion.
A little cushion. Yeah.
A little cushion.
Yeah, it's better.
Sure. So those people aren't going to move, right?
No,
they're waiting. They're waiting for rates to come down, and I don't know what level that's going to be.
I'm saying the people, and I'm going to say the people. I'm going to say the millennials, okay, that are now having children or now moving into the space of buying. They look at their friends that bought during that time, right? And again, how does that person have that house now that's $700,000 that was originally $4, now $7, or $650, and how are they affording that? And they're comparing them to those people and what they're able to buy at their current numbers now, and then if the rates do come down, what they're going to be able to buy. But again, we talked about this. Once the rates come down, what happens too?
I think inventory is going to skyrocket.
Well, I think inventory is going to increase. I don't think it's going to skyrocket because the same thing we just talked about. I think people are still going to stay because they can't afford to move or move up. But I also think that it's going to be the supply and demand model too. Sure. It's going to come into effect. And what that means is, if we're having 17 showings on my house at $650,000, we're underpriced.
Right.
We should price this thing at $7.
Right.
You know, and then what
They
is
don't.
that?
They don't think maybe you have 17 showings because your house is 650,000.
Yeah, correct. But but again, it's going to bring all these people back into the market that can buy. But then if they could buy that 6, and now the 6 is 650, 700, 715, whatever it may be. Are those people qualified now to buy that? No. So now they're down to a different house in a different neighborhood and with different amenities that the homes would improve.
Right. There's also the population situation, right? The people that are coming in and leaving. Like everybody says, oh, everybody wants to move to Florida. That's true. But a lot of people are also leaving Florida. I think last year in 2023, we had a net influx of only like 40-some thousand people, 45 or 44. I forget the number. I think it's somewhere around there. But people think, oh, millions of people are moving to Florida. No, because a lot of people are moving out because they can no longer afford that you live in Florida.
You got a lot of
Your
halfbacks
insurance.
at this time.
What's a halfback? I don't know.
A halfback, so they don't go all the way back up north. They go North Carolina, South Carolina, Georgia.
Okay.
Georgia, North Carolina.
We call them snowbirds. You call them halfbacks?
Well, they were snowbirds originally, right? So they came from the north. They came down. They came down during the wintertime.
Yep.
But then they were in Florida. And this wasn't typically because of pricing. It was just because of I don't really like Florida.
Yeah.
But I don't want to go back to the East Coast or Pennsylvania, New York, New Jersey. They would go halfback.
I got you.
So
North Carolina, South Carolina.
The Georgia, South Carolina, North Carolina, the halfbacks.
I got you. I like it.
Yeah.
I like
it's
it.
It's a good catchy term. I think we've seen a lot of people too who are in the Florida space leaving Florida because of the cost of living, especially as you get closer to the Gulf of Mexico and everybody that's coming down here. You have the larger corporations moving here for obvious reasons because you can do great business here. You can move to Florida with your corporation, but you're having people move to Florida with big pockets and seeing what, that's $1.5 million. I just left a small house in California for $1.5 million.
I'll take it. Yep.
Yeah,
I'll take 2.
Yeah,
right.
And then again, that causes the market to move as well. There's a lot in the real estate space, obviously. Yeah. Obviously, that's where I focus, and you're on the other side here with the investments and things as another add-on to people's portfolios, right?
Yep.
As we venture through this conversation here, and I know we don't have too much more time, but what do you think people should be looking at moving through the summer into the new year as far as personal investments and where they should be focusing their time and energy, besides obviously working with a professional in the space that you're working in, like yourself?
Yep. I believe that we are in and or heading into a recession. Rates are going to come down. So you can look to fixed income type investments like bonds. Longer term bonds are going to be better. That's we moved into longer term bonds. I think I said this in our last conversation.
Yeah, we talked about it a little bit.
I moved to long-term bonds about a month ago from 1-month Treasury bills because the 1-month Treasury bills are paying us like 5.35. The longer-term Treasuries are not paying that high of a yield. They're paying like mid-4s or low 4s now. But back then they were paying a little bit more. But I earned 4% just in the month because I got appreciation out of it. So I'm not only buying bonds for income, I'm buying bonds for income and appreciation. So that's one thing that people need to start kind of thinking in their head. Hey, I'm not just buying this bond because I want to get a 4% yield. I'm buying this bond because I want a 4% yield and I want 10% if rates go down 2%. And that's what they're talking about, lowering rates by about 2%. And that's another little kind of full circle to recession. Anytime historically, from the beginning that we have records that the Fed has cut rates by 2%, it was right before a recession.
Yeah.
So. And that's what the markets are pricing in. The markets are pricing in 8 rate cuts, which is 25 basis points each or a quarter point each, which is going to be 2%.
So where do you think the rates are going to go to? Oh, come on. Come on. Give it to me. Just give it to me.
I can't imagine they take it back to 0 because that's cataclysmic.
Yes, agreed.
But, I mean, they could probably cut by 2. But here's the problem. The Fed's trapped. And I write this out to our clients all the time. The Fed is completely trapped. And they're trapped because if they lower interest rates, they blow up what's called the yen carry trade, and I talked about that last week, which is why the markets dropped 1,000 points last Monday, and everything kind of fell apart because Japan increased their interest rate by 0.25%. So if we start dropping rates, that blows up the carry trade completely. In addition to that, when they start dropping rates, we're probably going to see inflation start to spike again. Because what's that going to do? What's going to create economic activity? What does economic activity create? Well, it creates inflation. Right. More houses are going to sell.
People are going to have more money in their
more
pockets.
people got more money.
Yeah.
The small businesses are going to have access to cheaper capital, so forth and so on. So that's
and we didn't even tap into the commercial space, too, which is a whole other podcast.
That's a whole other podcast.
Yeah, it's a whole other podcast.
That's right.
But coming soon.
Yeah.
Coming soon.
Yeah. And well, so fixed income, longer term bonds would be a place that I would tell people to start to look at. Obviously, I'm a gold bug. I love gold. It's our staple in our portfolio. It's one of our biggest holdings in our portfolio. It's been one of my biggest holdings in my portfollios. I think gold's great. Now, you have to be careful when you're buying. Like, don't go run out and buy long-term bonds and buy gold.
Right.
This is not investment advice. Speak to your financial advisor. But, look at it and understand, like, disclaimer, right, where you want to buy that stuff at. But, and make sure it's in your portfolio in a proper amount and you understand what you're buying and you can use it. The other area is, right now we have what's going on in the Middle East. You have a crisis in the Middle East. So I told you last week, I bought oil last Friday. Well, I sold the oil yesterday. I took a 10% gain for the week. And 80 was my target. Hit 80 literally yesterday. It hit like 80.19 and I got rid of it. And now I'll just wait for oil to pull back a little bit. It runs 10% a week. It's probably going to pull back even if there's a war in the Middle East. Now, if the war comes in the Middle East, we're probably going to see $85, $90, $95 oil. Well, oil's a great thing to put. Now, the challenge that a lot of people have is they don't even know how to put oil in their portfolio.
Right.
Like, there's different ETFs you can buy. So you have to be careful which one you're buying. That's a whole other conversation. But
define ETF for people.
An exchange-traded fund. It's like a mutual fund, but it trades every second of the day. And you can buy it at when the price of oil was 71, 72 last week. That was my target. So I bought an ETF that tracks the price of WTI, which is West Texas Intermediate. There's also other ones that track Brent crude and a couple of other different types of oil and commodity things.
ETFs basically, you have to look at those as the commodities.
Yes.
On the commodity level.
Yeah, there's not a lot of
about
mutual funds that have
commodities, I mean, I know we talk about frozen orange juice, we talk about, cotton exchange, you talk about oil.
Right.
Those are the commodities that are out there. And that's just a few folks, just to name a few.
Yeah. So I like the commodity space a lot. And again, if they drop rates, if I truly believe inflation is going to come back and rear its ugly head again, well, then the commodity space is probably going to get set on fire again. So we're probably going to see commodity prices start to rise.
Indeed.
Right?
Indeed.
Again, and if we have war. So, I like longer term treasuries. Gold's a great spot. And, pick your spots in certain commodities. And I think you'll be able to weather the storm. I think if you haven't already reduced your technology exposure in your portfolio, you probably should. It's 35% of the S&P 500 right now. It's like 7 stocks. And when you have that large of a concentration of tech stocks, essentially, it usually doesn't end well. Let's just put it that way.
Right.
So, you should probably look at trying to reduce that or at least capture some of your gains and book some of those gains and stick it someplace else and diversify a little bit. That's
diversification
another issue that a lot of people
is key in any financial planning.
Yep.
I mean, obviously.
Yep. And it doesn't...
Even in your real estate portfolio.
Yeah. And
diversify it.
Yeah, of course. But diversification doesn't protect you from loss.
It does not. It doesn't.
Because when things go down anymore, everything goes down together. Small cap, mid cap, large cap, growth value, doesn't matter. It's all going down together.
Right.
And same thing on the way up anymore. So most people don't have commodities in their portfolio. They just don't have it. Like I talk to financial advisor friends of mine, what percent do you have in gold? They're like, what? Gold? And they laugh at me.
Yeah, of course they do.
And I'm like, oh, okay, I didn't know that.
Again, big institutional banks, big institutional companies. I mean, Bank of America, Merrill Lynch, part of Bank of America. I mean, what do you want to call it? What do you want to call it there? The culture? The culture that comes into play?
It's a set it and forget it type portfolios.
Correct.
That's what they do.
Correct.
They're set it and forget it portfolios.
Yeah. The wealth management experts
Correct.
in the world. Yeah. So anyway, I wanted to thank you, Raymond, for coming on today. And listen, if you guys haven't had the opportunity to meet with Raymond or talk to him personally, and you would like to, follow the link below. You can click. I'll actually put his calendar on there. You can book an appointment with him, and you can link him up to his personal page as well as his contact information. So, again, Raymond, thank you for being with us today.
Thank you.
Totally appreciate it. Outstanding time with you here today. Again, I'm Robert Dinan, your Florida Realtor. This is Luxury Living Florida, all things Florida, and we'll see you soon again. Have a great day, and looking forward to seeing you here in sunny Florida.